Now this is a very interesting picture. It shows that if $1 was invested in 1926 in small company stock, it has grown to $21,997. And if it has invested in large company stock, it has gone to $3,247. And if it would have invested in long-term government bonds, in 2012, it has grown to $112. So this shows that obviously that small company stocks are very risky. So there are chances, more chances that they will go bankrupt. Um, so because it was these stocks are more risky, they end up getting more reward at the same time. So this is actually from the empirical from the historical data, we can see that there is a relation between the risk and return. So large company stocks are stable, but they have also generated less dollar returns. So $1 in 1926, which was invested in large company stock, it turned into 3,247 only, compared to 21,997 if it would have invested in the small company stock. This is another interesting picture. If the $1 would have invested in 1812 in the stocks in 2000, by the end of 2012, it has converted into 14.6 million. And if you see the bonds, it has turned into 36,299. So obviously the bonds are way less riskier compared to the stocks. So higher the risk, higher the return. This thing seems to be established if you study the data, historical data from the financial markets. This picture is showing the total annual returns uh, in terms of percentage over uh, the period from 1926 to 2012, and most of the year the return you can see was positive. But look at the range. If you would have invested in the large company stocks, this is related to only large company stocks, the return was over the scale of 40%. I can see that the maximum return is around about 50%. And there have been losses as well. For example, right after the Great Depression, it was almost minus 40%, in fact, during Great Depression. And then in 2008, when the recession hit, uh, uh, it was around, I can say that around 35%, or in fact 38%. But if we will compare this picture to the investment in small company stock, the next one, you will be surprised by looking at the scale. Because the small companies stocks are very riskier, so the return the investor also need very high. So you can see that return is in fact touching at 150%. This is, remember, this is an annual return in a given year in terms of percentage, right? So in one year it was almost 100%. Many of the returns are above 50%, and the loss also touched uh, to the 50% in few years. So again, higher the risk, higher the return. If you take more risk, there could be more return as well. So US T-bills, they are very safe. They like as we are expecting. In this case, we do not think that there will be any negative return. We are very safe, and you can also see that most of the returns are around the range of 4%. In fact, much more is below 4. For many years it is below 4. In fact, right now it's almost nothing, right? Because the US wanted to generate more economic activity in the current times. So there is less risk because the US T bills are backed by the government of United States. So there is less return as well compared to the large company stock investment and the small company stock investment. Now, one thing which summarizes the return over the period of time is average return. And we know how to compute the average. I'm guessing most of you. So the average return is you add up the annual return of each year and divide by the number of years. So let's suppose if you have 10 years, you will compute the percentage return for each of those 10 years, add them together and divide by the number of the year, which is 10 in this case, right? So this will give you the average return, and it's a very useful number because it summarizes that on an average what have been a return in a typical year. So if you see that from 1926 to 2012, the average return on a large company stock is 11.7%. So we added all the uh, annual returns for each of the years during this time period, 1926 to 2012, and divided by the total number of the years. And for the small company stock, it's 17.5%. For the long-term corporate bond, it's 6.6, and the long-term government bond, it's 6.2%. The USD bill is 3.7%, and the inflation on an average have been 3.1 year in a typical year. So this also shows that the return in the most risky instrument, which is the small company stock in this case, is the highest, 17.5%. And then comes the large company stock, which is 11.7%. And if you start going down with respect to the risk, you can see that the USD bill is generating the lowest return. Now, almost one third of the stocks are traded in the United States. So it means that two-thirds is also getting traded of the total. If we are considering that world stock market capitalization, if we consider that, so almost two-thirds of the market capitalization is beyond the borders of the United States. So there is a big stock market uh, outside the United States as well. Now, what is the risk premium? So we know what is risk premium, by the way. The risk premium is what is the extra return you are getting for bearing the extra risk on top of the risk-free, like on top of the risk-free return. So in case of large company stock, where the average return is 11.7, you subtract the risk-free rate of return, 3.7. So it will generate 8% risk premium. For the small company stock, the average return is 17.5. If you subtract from the 17.5 the US T-bill rate, which is 3.7, it will generate the risk premium for investing in the small company stock, which is 13.8. So it means that for bearing that extra risk for investing in the small company stock on top of the risk-free rate of return, it is 13.8%. So an investor wants 13.8% for bearing extra risk by investing in the small company stock. So this is on top of risk-free rate of return. So the investor is saying that, okay, risk-free rate I will get anyways by investing in the US T-bill. What is extra I will get by investing in the small company's stock? That is 13.8%. So this is called risk premium. So we can see that the highest risk premium again belongs to the small company stock, and we know the reason. It's actually the risk. Higher the risk, higher the return the investor will see. Thus, our first lesson is that there is a reward on average for bearing risk. So if you are bearing extra risk, you need, like as an investor, you want to get compensated for bearing the extra risk by having more return. That's why you need risk premium for investing in the risky stock.